Well, next reading is interesting. We're going to take basic ideas we've been talking about. Let's expand it a little bit. We've mainly been talking about financial assets and liabilities, but that's not everything that exists for individuals. Let's look at extended assets and liabilities. Let's look at other things. And let's get into the issue of insurance. What is the legitimate role of insurance products? How can they be combined in managing portfolios, managing the net wealth of our clients? What are the issues? So we'll explore those and a few other things in this reading. Let's start out with the idea of other things, human capital. If you're not yet retired, a client's going to continue to work. What's the expected present value of their future income? That's an asset. It may be harder to quantify. It may not be a legal asset, but it's still a financial asset. We've got to consider what's the probability they'll be able to work? How long will be able to work? What would we discount it at? How risky is that future labor income? But we could quantify their human capital. Their financial capital, all their other assets, the more traditional kinds of things. What about if they have a retirement plan? What about a Social Security if the government promises to pay them some future retirement income in retirement? We could calculate the present value of those. Those are more like explicit financial assets, but they're still not a normal stock or bond. We should think about all those things. So their total wealth is really their financial capital and their human capital. And then we need to remove all of their future liabilities to come up with their net wealth. So a more comprehensive way, more difficult, but a more complete picture of their situation. Human capital is not something we can look up. We'll have to make estimates. We'll have to project. What do we think they will earn each year going forward? What is the probability they'll be able to continue to work? And then we've got to discount that back. If we've done our projections in real numbers, not including future inflation, we could start with a real risk-free rate as a discount rate. If we've included future inflation in the projections, we would discount as a nominal risk-free rate. But human capital is not risk-free. There's a lot of risk. Some jobs are riskier, some are more stable. We'd also have to include an appropriate risk premium. But the principle is simple. If our projections are real, we discount with a real discount rate. If our projections are nominal, we discount with a nominal discount rate. But we also need to include a risk premium that is tied to how risky that future human capital is going to be. If you need numbers, they will give you numbers. You just have to know to pick the right ones based on these principles. In theory, if you're an average person not born to wealth, when you start out in life, your financial capital is zero. And your human capital, especially when you go to work, is very high because you're going to be working for a long time to come. As time passes and you age, your period to retirement is shrinking, your future earnings are declining, so your human capital would start to decline. And if you're saving and building up wealth to fund your retirement, your financial capital is increasing. Now, they drew these as nice, smooth lines. They're not saying there can't be major disruptions that bounce these around, but this is the basic idea. A normal person, when they retire, is not going to work again, so human capital would be zero. But let's just for a minute think about what happens at retirement. Many people have to think about, earning and distributing, and they're beginning to draw down their financial capital. We've got to worry about, are we going to outlive the financial capital? We've looked at calculations. We've talked about Monte Carlo simulation to analyze how long will the money last. If you're very well off, maybe you can earn enough to fund the distributions and maintain the value of your financial capital. In many of the questions we look at, we make the assumption that we're trying to maintain the real value of the financial capital. We're earning enough to cover the distributions and compensate for the effects of future inflation. Those are things we've looked at. And by the way, what's the definition of the super wealthy? I'd say I just drew it. They have so much money that the earnings on their capital, they can't spend it as fast as they're making it. So their financial capital actually builds even when they're no longer working because they just can't spend it fast enough to begin to draw it down. So it's an interesting way to think about this process. Stages of life. We've done stages of life in other readings. Here's another one. This one happens to be a lot more elaborate. That doesn't mean it's more important, but they do want to get in the idea of what kind of risk exists as you start early and then as you age, and what can you do about some of those kinds of risk. When you're still being educated, you're building skills, you probably don't have any financial capital. In theory, you have a lot of human capital, but you're not making anything yet. It's pretty uncertain. There's not a whole lot to talk about. There's not really a way to save. Not too much we can do in that stage. Early in your career, probably have very high human capital. You may be starting a family. You may have dependents that are counting on your ability to earn, or your client dependents are counting on the client's ability to earn. You might need things like life insurance, because if the client dies prematurely and can't earn, maybe there are obligations that continue on beyond their death. We're going to find out that's a perfect reason for buying life insurance. We've also got to be concerned, what if they bought real estate? What if they own a home? What if they own cars? There might be an accident that destroys the property. Maybe they need property insurance to protect against loss in value of those items. As they develop their career, they should be entering a phase where they start to save and accumulate financial capital. They probably still need life insurance. They still got a long time to work. They probably need property insurance. They get into that period of peak accumulation where their level of earnings, human capital earnings, are very high, and hopefully they're really saving a lot to build up to fund that retirement. That's when financial capital accumulation should probably be very, very rapid. So we're giving generalizations. Any one case could be different, but these describe normal situations. We move into pre-retirement, where you're really starting to plan how you're going to fund the retirement. When do you retire? When do you think you have enough money to be able to comfortably and safely retire? You get into early retirement, initial retirement. Let's not assume expenses go down. Hopefully you've retired when you're still healthy. You can do a lot of things. You may actually want to spend more money and enjoy things, do a lot of travel. You have to start to worry about outliving your assets. We're going to see, and we're going to start talking about annuities. An annuity is an income stream that cannot be outlived. It will pay you as long as you live. Maybe you should think about purchasing annuities. What about late retirement? Maybe the expenses start to go down, you can't do things, or maybe they don't, because health care could be a problem. How is that covered? Does your country provide health care, or do they leave it up to you to figure it out? And of course, as people get very old, senility, their brain functions can deteriorate. They may not be able to make decisions well. Those things have to be thought about in advance and planned for. So a nice sketch of things to be aware of. That's the way I would treat those slides. So let's sum this up. We should be looking, instead of at a traditional balance sheet that has explicit assets and explicit assets, we should do what they call an economic or holistic balance sheet. Let's include everything we know. Now, the problem is those additional things may be more difficult to estimate, but it's still worth it because it gives us a more comprehensive view of the true situation of our client. A good way to think about things, and a good introduction as we're going to move into looking at the details of some of these items we've just previewed.